More than 83% of the people around US use a credit card to make their purchases. Does this mean that they have a higher purchasing power when they have a higher credit limit? Certainly not. This only means that they are drowning in debt for which they do not have the money to repay. So let's focus on 4 things in this video. Number 1, how does a credit card payment cycle works? Number 2, how does a credit card transaction functions? Number 3, how does a bank earn when we use the EMI or the monthly installment plan? And number 4, things to avoid for sure when we're using a credit card. So let's dive in. Alright, so let's break down the credit card payment cycle in a way that's easier to understand. Let's imagine that you have a magic wallet from which you can draw money every time you need to make a purchase. Now this magic wallet can be your credit card. But the thing is that if you make a purchase using that credit card, you will have to pay it back sometime in the future. But you do not have to pay it right away. There is a payment cycle that you follow. Let's say that your bank allows you a certain time to make a purchase, like a month. This is your starting point, just like the beginning of a race. During this time, you can make purchases using your credit card. And every time you make a purchase, it eats up from the credit limit that the bank has allowed you. When 1 month or whatever term your credit card company has given you is up, that is like the end of the credit card purchase term. After this term ends, your credit card company sends you a bill. Now this bill includes all the purchases that you made using your credit card. And how much does it cost you altogether? Your credit card bill has a due date. Now this is the date by when you have to pay back all the borrowed money. And if you pay back all the borrowed money by this date, you do not have to pay anything extra. Sometimes your credit card bill says something like a minimum payment due, which is a way of saying that if you cannot pay everything back by the set date, at least pay this amount so that you can keep the credit card and keep spending on it. Now, just remember that if you pay the minimum amount back, you will certainly have to go back and pay rest of the amount with interest in future. Now let's break down the different players involved whenever we use our credit card to make a purchase in a way that's easier to understand, so we know exactly who earns when we use a credit card. The first one is a merchant. Now imagine that you are at your favorite store ready to buy some snacks. That place is called a merchant. It could be a supermarket, a clothing store, or even an online store. The merchant is the one who is willing to sell you goods or services that you need to buy. Now let's talk about the company that gave you the credit card in the first place. That company is known as an issuer. It could be a bank or any other financial institution. This is the company that approved your credit card application in the first place and gave you a credit card to use. Next up is the network company. Network company is the one that helps you process the transaction by connecting the merchant and the issuer. There are different network companies like Amex, MasterCard, and Visa. These are the companies that help you process the transaction once you swipe your credit card. It's like a bridge that helps with the flow of transaction between the store and your bank. Lastly, we have the acquiring company or the processor. The processor is responsible to handle the transaction between the merchant when the credit card is processed. When you make a transaction, the acquiring company is responsible for transferring the money from your bank account to the merchant's bank account. It's like a messenger that transfers your money from one account to the other. To put it all together, let's imagine that you are buying a pair of shoes. You go to your favorite shop, the merchant, to make the purchase. You select your favorite pair of shoes and make a transaction using your credit card. The store's card reader communicates with your bank to process the credit card transaction. The store's card reader connects with the network company to process the credit card transaction. The network company connects with the issuer, which is your bank, to check that you have sufficient credit card limit to make this purchase. If everything is okay, the acquiring company will transfer the funds from your bank account to the merchant's bank account and the transaction is completed. And you walk out of the store with a new pair of shoes. So in summary, in a credit card transaction, a merchant sells you the goods, an issuer issues you a credit card, a network company facilitates the transaction, and an acquiring company actually transfers the fund from your bank account to the merchant's bank account. So imagine if you want to make a purchase of $100. Once the network company approves the transaction, the issuer will give $98 out of that 100 to the network company. And then network company will keep $1 and pay $97 to the acquiring company. So as a summary, in short, you see that issuer bank is the one that earns the most amount of money whenever you use the credit card. That is exactly why banks want you to use their credit card once you make a purchase. Now let's break down how the banks actually earn money when you use the EMI or equated monthly installments by using your credit card. First stop is interest charges. Whenever you want to make a purchase using your credit card and use the EMI, the bank is essentially lending you the money to make a purchase. They are facilitating you to pay back that money equally in the coming months and not upfront. But it comes at a cost, and that cost is the interest charges. Banks usually charge you an interest rate on the total amount that you borrow from them. In case of an EMI, your interest is decided on the amount of your purchase, the interest rate that the bank sets for you, and the time that you want to pay back the full amount to the bank. So every month that you pay an installment to the bank, a portion of that installment goes towards the principal and a portion goes towards the interest charges. In addition to interest charges, bank also charges you a processing fees upfront while you are setting up your EMI. Now, this includes all the paperwork cost or the verification cost and the administrative charges that they incur while setting up your EMI. Amount of those processing fees depends upon the bank that you are using. Then comes the late payment charges. If you fail to pay the EMI on time, banks impose a penalty. Now this is a penalty for you not sticking to the agreed payment plan. Late payment fees often adds up to your purchase cost and you end up paying even more than the agreed cost with the bank. Next way the bank earns from you is through the exchange rate for the foreign currency transactions. Now, if you are making a purchase in a currency that is not your own, for example, if you are buying from an online store in another currency, the bank may also earn through the exchange rate fluctuations. They might offer you to translate that currency into your home currency using a certain exchange rate. Now, this exchange rate also has a certain markup that adds to the revenue of that bank. And lastly, the banks earn by cross-selling their financial products. This is not directly linked to the EMI plan that you get, but banks do not miss a chance to sell you their other products including insurance and investment plans. So these are all the avenues from which the bank earns whenever you decide to use the EMI facility. Again, in summary, a bank earns through charging you an interest rate, processing fees, late payment charges in a form of penalty, cross-charging for their financial products, and through exchange rate differences. And this brings us to the last and the most important part of this video. We as a consumer, how can we avoid paying any extra fees and how can we draw the maximum benefits from using an EMI or our credit card alone? Number one, never pay the minimum amount due on your credit card, because in this way you cannot avoid the hefty interest charges and you actually end up paying way more than you owe. Number two, never use one credit card to pay the dues of the other credit card, because in this way you will still incur the processing fees every single time. Number three, never use a credit card to draw money, because it does not operate like a debit card. Every single time that you use your debit card to draw money from the ATM, you are essentially drawing the money that you already have in your bank account. But if you draw your funds using a credit card, you are essentially taking a loan from the bank, on which you will definitely incur interest charges. Number four, never draw a credit card with a higher annual fees. Let's say you have a credit card that gives you reward points for every time you plan a travel, but you only travel once or twice in a year. So the cost is actually higher than the rewards that you get. Instead, choose a credit card that gives you reward points on necessities like groceries, and choose a credit card that does not have any annual fees. There you have it. You know now exactly what happens when you use your credit card to make a purchase. If you like my video, please do not forget to subscribe to the channel so we can bring you more valuable content in the future. Till the next video, have a safe day everyone.